Welcome to the Fund Selectors podcast with me, your host, Lucy Walker. I am a huge supporter of the voice of the fund buyer, and this podcast dives deep into the minds of the biggest and best in our industry. In today's episode, I'm delighted to be joined by Matt Piro, Global Head of Oversight and Manager Search at Vanguard. Yes, Vanguard, the $10 trillion asset manager mostly known for passive. Indeed, the asset manager who most often is cited when people are looking to bash active management. Yet, of Vanguard's assets, over 750 billion of those are invested in active management. Matt's team is responsible for selecting the external sub-advisors. He's got a team of 24, and there are 80 externally managed mandates. Our conversation touches on the way that Matt structures his team, the level of detailed due diligence that a team of that size allows them to conduct, and the incredibly long time horizon that they have both when selecting managers, often it can be years for them to be comfortable enough to invest, but also then to hold. They're looking ideally for multi-decade holdings of their managers. I found it, as ever, a fascinating conversation, and I hope you enjoy it as much as I did. Alrighty, Matt, welcome to the Fund Selectors podcast.
Oh, thanks for having me, Lucy.
My pleasure. So you are at Vanguard, which a lot of the audience are probably going to be wondering why we are together on the Fund Selectors podcast today. So I wonder if we can just start with a brief intro from your side on what your role entails at Vanguard, and a lens into this part of the business which is perhaps less well known to many in the industry and beyond.
Yeah, I think that's a good place to start, and it's one of the things I enjoy talking a lot about, because I think, as you're kind of alluding to, Lucy, is there's certainly Vanguard's very well known on the passive side with tracker type products, but active is where Vanguard started. In fact, if you go back to the history of Vanguard, when we first set up shop in the mid 70s, we started with active management, and so we've got quite a long history and lineage with active management. So it's something we've always believed in and always done. So the great thing about being a part of this organization is we've continued to expand and we've diversified the lineup, but we have remained incredibly committed to active, and that's where my role comes into play. That's what I do. So me and the team, we do all of manager research and selection of the sub-advisors of our funds, and a lot of that is focused on the actively managed side of the business. So a lot of people are surprised to hear that Vanguard has such a big focus on active. If you look across our lineup across globally, they're very surprised to hear that we have over $700 billion in assets run actively by third-party managers. Those are the managers that we're actively selecting. So my job is manager research. It's exactly what we do, and it's active focused, and it's very fun, and it's a big part of what Vanguard actually stands for.
Awesome, thank you for that. Really, really helpful, and yeah, a huge sum of money. Obviously, actually a decent percentage of your overall AUM, but nonetheless, obviously the minority, but clearly in kind of global standpoints, a significant sum of money invested in third-party funds. So I guess it would be really helpful to start with how when you're thinking about your process. Obviously you're heading up the that side of the business now, so give us a sense of how do you direct the team, what's the process around sub-advise, presumably pretty long tenure in terms of the managers that are selected. So yeah, it would just be helpful to start there.
Yeah, I mean, I think that, a couple of things I touch on here is first, process wise, it does start with the team. So we have a 24-person team that's full-time dedicated to manager research and the selection of these advisors. And the process itself is long-term, and that's partly long-term in the way we approach the selection, but it's also long-term in the way we think about evaluation and the hopes when we do engage with the manager on the tenure of the relationship. We do want it to be a long-term relationship. So one of the things that is very core to our process is do your homework up front, which does take a lot of time. In many instances, it's years of due diligence before we strike a relationship. And that's with the intention of, once that relationship is struck, it is one we start to measure not just in years, but hopefully, quite frankly, decades. So we want to do that work up front to have us be able to stick through over the long term with managers, because one of the things within our philosophy is around long-termism. Simple things like, we all know managers are going to have periods of underperformance. It is a lot easier to stick through those tough times when you know a manager very well and you understand that. You do have to be willing to move on, though. So you can't just be long-term for the sake of being long-term. And again, having that incredibly deep understanding of the manager so that you can detect changes, sometimes for the good, sometimes for the not good. And those are the times when you help to move on. So a lot of the philosophy and process is underpinned around long-termism. But part of what we do is very much about resourcing. And it's making sure we have the people, the depth within the team, and then the tools and techniques that we can then apply using those tools to really have that very strongly informed view of a manager, so that we know when to move and when not to move. And that's, I think, those of us in this business know that is one of the hardest things to decide, is when to and when not to. And it's particularly tough during periods of underperformance, as I think we all know.
100%. Yeah, that specific topic has come up many times on the podcast so far. So decent sized team, right? 24 people is well resourced. What can you give us a sense for kind of how the work is broken up in amongst a team of that size? And just so remind us, 22 relationships, 22 sub-advisors across about 80 mandates.
That's correct. Yeah. So 22 different firms, across 80 different mandates. So some of these firms run multiple mandates for us, some run a single mandate for us. It just depends on what they do and how we want to deploy them. But on the team point, the way we set up the team is we have a team of senior investment directors. Those are the individuals that have primary responsibility of coverage, which we typically break up based on a style or a specialization. So think value equities, growth equities, so on and so forth. So we try to have an area of specialization for each of the senior directors. But we also intentionally sprinkle in some coverage that's outside of that specialization. And that's done because what we want to make sure we do is as we operate as a team, there's enough breadth within the senior directors so that they can challenge one another as we're engaging on different manager ideas. So of course, I look to the senior director first in terms of the opinion on the manager and how we should deploy them in a fund, manager weightings, et cetera. But I want that idea to be effectively beaten up by the team. And one of the ways you do that is you give folks enough latitude to have some breadth of knowledge to then bring that in and apply it across those team debates. So we have 5 different senior investment directors who have a primary area of coverage. We have a director of applied research, who is the individual that is charged more with the analytics and the like that we use across the assessments. And then we have one senior risk manager who partners with our audit and compliance type teams on more like operational due diligence, compliance matters, very important parts of what we all do, but a little bit, less direct investment. Each of those individuals have a team of analysts that they have directly supporting their book. It depends on the number, 2 to 3 analysts roughly that end up supporting each of those senior members of my team. So that's roughly how we're set up as a team.
Nice. Yeah, that makes perfect sense. I think, yeah, as well as kind of that challenge point, there's also just the impact of covering different areas and the kind of the read across that you get, from different sectors, different even asset classes. Sometimes, that is hugely powerful, isn't it, in the process? So yeah, I can see why you've taken that approach. So if we think about your team and the fact that, as you said earlier, sometimes it might take years for you to make a decision, can you kind of walk us through some of the things that you maybe think that with what I would consider to be a well-resourced team, what kind of things you feel like you guys do that maybe a smaller team might not have the capacity to do, that's kind of taking that time and letting and giving you that sort of slow build-up of confidence that you're getting over that period of time?
Yeah, it's something we think a lot about, because just like all of us in our profession press managers to describe their edge, I think it's a fair question to ask of us. Well, what's your edge in doing what you do? And one of the things that we do think is part of our edge is what your question is touching on, is the depth of resources and the focus that we have. We're able to do very thorough research over periods of time. So it's, we never want to be in positions where we are reacting. We are very much proactive in the way we think about managers in terms of the assessment, even when we don't work with them, and then as we oversee them and are continually assessing them. So what I mean by that is a lot of the work that we do is kind of deeply analytical, where we are evaluating individual decisions, portfolio construction decisions over periods of times using, I think, somewhat enhanced analytical techniques, because we have great access to the managers themselves. We have great access to the data, the trades, the portfolio. So we see daily trades. So we can then go in and start to do analysis on the kind of more behavioral based analysis, when we can start to get a sense for timing decisions and things like that for a manager, something that is a topic I'd love to, we could talk more about too, because I think it's an area a lot of fund managers are thinking about, trying to understand some of the behavioral, biases they may have just in the way they build a position or exit a position. We do basic work, of course, like the sector attribution using Brinson type stuff. That's informative, but we don't lean on that very much at all when we think about the assessment of managers. So part of what I think we're able to do is customize our analysis for the managers, perhaps more than some might think to or can, because of those resources in the data. So what we try to do with that type of work is, for every manager that we're evaluating, we tend to think there's 2 or 3 customized looks that give you a pretty good insight into their philosophy process, how efficacious it is, how well they've executed on it, whether it's been rewarded or not. And we're doing a lot of custom work. So any set of analyses we're doing for one manager does not look the same for the other manager. And I think the resources that we have, the focused lineup that we have, the long-term approach that we're able to take, I think it enables us to do that. So when I try to think about how we differentiate ourselves in this space, I would put that very high on the list. Very high on the list, which is what I think we do differently.
Nice. I'd be really interested to hear about an example where you were maybe recently, or however recently, you kind of evaluated a set of managers to choose a new sub-advisor or a new mandate, how that analysis maybe influenced your, well, presumably by the sounds of it, definitely influenced your decision to go for one manager over another. And I would imagine there's a couple of lenses that come into play. One is obviously just what the data tells you, full stop, and you have your interpretation of that. But I would imagine that there's also quite an interesting angle from the perspective of what you learn from the data and how it correlates to what you were told by the manager. So I'd just be interested to kind of dig into that a bit more.
There absolutely is. That is definitely the case. And one of the things that we say a lot is, when we're engaging with a manager, sometimes you go, this is what you say and this is what we see, right? And to your point, you want to see alignment of that. There are times where we might see something in our analysis and it might actually be something the manager hadn't thought about. And that's not necessarily a bad thing. It's something for us to further engage on. And there are examples in times where something we've brought to a manager has led to them to go back and reflect on the way they've done something within their process and improve. And so there's definitely some examples of that, and some of that's come around trading, which is kind of an interesting area to dig into as well. But specifically to your question, if I think about in the last few years, there's one manager in my mind that we parted ways with, right? And this comes to, what did we start to observe, right? And what we started to observe was multiple ways in which we identified what we would loosely refer to as style drift, a very common term in our industry. And it's one of the, I think, perhaps one of the quickest ways managers can get themselves in trouble is by not sticking to their philosophy and process. Now, you have to be careful, because sometimes you do want a manager to adapt to the markets and learn, but full-scale changes are typically things that we don't like to see, right? And I think that's a common kind of starting point for manager researches. But what we observed with this particular manager I'm thinking about is the sources of their value add started to change. And it coincided with changes within their team. And it started for us to kind of develop a story that not only did people changes start to maybe bleed into research changes and then ultimately the portfolio construction, we started to observe that what led to the success in the past was something that we began to question was going to be the case in the future. So you almost had to think about the manager differently on a go-forward basis, where you say, I'm not sure we can rely on the historical sources of value, which were very good and we were very happy about on a go forward basis because of what we started to detect in the analytics, but also through some of the interactions that we would have. And that's part of what we do, of course, as manager researchers, is you're blending qualitative and qualitative insights. And we try to measure anything you can that you have from a qualitative insight perspective, but you can't measure everything. But what you try to do is put that mosaic together to come to that informed opinion. So I'd say that's a recent example of the last few years where there was a manager where multiple parts of the analytics were starting to point to something changing. It married up with some qualitative insights and some other observations. 1 + 1, next thing you know, we go, it's time to move on. So that's one recent example on the way out.
Nice. And it sparked a thought of actually kind of logistically how that worked within the team. So obviously you've got your senior directors who have got, ultimate responsibility for the different series of mandates, and they've got their analysts. You've got your team of 24. I imagine there are kind of the pods of the seniors with their analysts who are doing some kind of deep dive, and then that maybe starts to kind of filter out more widely when they maybe observe something that needs to be discussed more broadly. Would just be interested in that kind of, small team versus big team kind of interaction.
We operate in both ways. So as you described, like the pods, is they're doing the day-to-day work. They're coming up with the ideas. They're the opinions that will lead to the start of a conversation. But we also meet every week as a team at least once. So once or twice we have team meetings. I'm a big believer in operating as a team, and there's multiple reasons why this is the case. And a lot of it is, quite frankly, learning and development focus for analysts, because it's one of the ways you learn. You learn by observing. You learn through engagement. So like this form of analysis that we're talking about in this particular example is one that not only did the senior director and their analysts, were they the ones doing that day-to-day, putting together the different pieces of that mosaic based on the site visits and the analysis, working with our director of applied research to, enhance the analysis. I look at that individual as a bit of a consultant for the whole team and can look across the book, which is an amazingly powerful role to have. For those out there that maybe don't think about a role that sits across, it's one to think about, because I just see incredible value in that ability to connect different dots and across the lineup. So those individuals will come up with that view. We'll bring it into a team meeting and we will beat it up as a team. And the analysis will be presented, questions will ensue, observations will be shared, and it should help and does help the senior director further their opinion. And then ultimately I have to sign off on things. But I really do look to the team to say, you're the closest to it. I mean, I go meet with managers and I look at the analysis, but I don't meet with all the managers all the time and I don't see all the analysis, right? You build a good team, you build a strong team, you want to trust them and let them do their work. But we do it both. So we do it within the small pods, but then we do it within the broad team. And I think over time, and we refer to the work we do as a program, I think it just helps the program advance and get stronger year in and year out. So that when we look back 10 years ago, and I can look back 10, 15 years ago because I was in the team starting in 2008, I look at the work we did then and the way we did that work, and I look at the work we do now and the way we do that work, and I'm like, wow, I thought we were really good then, and we were. But now it's like, wow, we've made some serious advancements here. And I think it's all these little things that we've done over time and the way we operate as a team that's allowed us to advance the program in that way over that period of time.
Nice. And you ended up hitting on exactly the point I was going to come to, which was that, you referenced this kind of the trust the team and the insights that they have and the learning opportunities that kind of interactivity gives them. And I was going to mention, of course, that you had, and as you say, since 2008, been through this process. So it must be a real advantage for you to really know, actually, I imagine, every step of the process of all of the different people that you have on your team, or the different levels of your team, because you've been there, you've experienced it, you understand their, both their kind of opportunities, but also their challenges. And so how has that kind of come into your thinking? How much is there, obviously you say there's been loads of learnings, and that's the best way to do it, right? We can all, if we sit here and say there's nothing to learn, then, there's something's gone wrong, because that, as you say, that will always happen. And so I'd just be interested to know, you mentioned a lot's changed, but sort of the team structure, is that something that you brought in since you've had this role currently, or has that kind of existed for a while?
There's been some changes over the years in the way the team's structured. And I took over this role leading the team just about 2.5 years ago. My time goes back, as you alluded to, back in 2008, as I started as an analyst, worked my way up, was a senior director. And the individual who ran the team, his name was Dan Newhall. He ran the team for 15 years prior to me taking over. So that's who I learned under. That's who I worked under, right? And so a lot of these advancements in the way the program's evolved, it's a big credit to Dan and what he's done with the team. And there's a number of us who have been around it and part of it for a very long period of time. So we've been part of that change. We understand the history, we understand the context. But there's also a lot of newer blood, and that's very healthy. So one of the things we've always tried to think about is this type of work, it does require time and experience. Like, I genuinely believe you need to follow managers and do this kind of work for a period of time before you really know it. You really know it well. But there could be an issue if you have too much of that in a team, because then you are maybe a little bit less adaptable. Maybe you don't bring as much change in, and that's where fresh perspectives and new people come into play. So from a team perspective, we're always trying to balance keeping a really nice, stable team, both at the senior and analyst level, but also introduce some change within that as part of preserving the core and stimulating progress kind of mentality that we have. The team structure itself, in terms of some of the specialization, I'd say that's an area we have evolved a bit over the last 3 to 5 years in particular. If you go back 10 years ago, we were less specialized. We were more broad, if you want to call it that, where there was a little bit less of a focus in, say, value equities or growth equities for a senior director than today. And I think that's just something that we've evolved towards, because the depth of expertise as you face off with managers, I just think the bar's gone up on that. And I think that's one of the ways that we've tried to evolve to kind of keep up, if you will. And there's pros and cons to both models, in my opinion. I think they both can work, but we've went that route because we've just found that the depth of expertise brings a little bit more to our analysis, our ability to engage with fund managers, our ability to engage with the analysts and the risk professionals at a level that's a little deeper than they might be accustomed to, where we think we can, and we never know for certain, but where we think we can glean some unique insights. So there has been some changes in that specialization model over the last 5 years or so.
Yeah, no, makes perfect sense. And yeah, I think it's a sort of reflection that I have of my own. So I started at HSBC, where it was like, couldn't have been more specialized, and then went to Saracen and Partners, which was like covering everything, every asset class, every fund structure. And so I've really seen sort of both extremes. And actually, I do think the best answer is somewhere in the middle. I really loved looking at everything. I was early in my career. It was, the best kind of learning ground, right? To just kind of keep expanding your, all that learning just constantly every single day, actually, probably multiple times a day. But actually the reflections since leaving are that actually a bit more specialization, to all the reasons you've just said, are hugely beneficial. So yeah, I think it makes sense where you've landed. So can we dig into, the team is obviously looking at both the monitoring of the existing names, but you sort of alluded to the fact that they're also going to be thinking about new options for the future, possible substitutes for existing managers, just to kind of be keeping tabs on those. Can you give us a sense of, you've got 80 mandates, which is actually quite a lot. I don't know whether some of those are similar or whether those are all kind of really distinct. It would be useful just to understand the kind of overall coverage. So you've got your kind of 80 mandates, and then what are they sort of looking at in aggregate when they think about the sort of what's on the bench, as it were?
Yeah, so the coverage for prospective managers, or what we would call manager search, is aligned to the coverage with that specialization of the oversight. So value, growth, et cetera. And part of the job of the senior investment director is to be meeting with other managers all the time. I think it's for a few reasons. One is, to your point, substitutes, maybe to support new products. Like when we launched our UK range, we had to bring managers in. So we wanted to be ready to do that. So we can support new product development in some instances when it's needed, but then there is the substitute point. So we have to be ready with a well-informed, highly rated manager when that time does come. So that requires, think about that long-term approach I mentioned earlier about how much time we take to get to know a manager. Well, it means you have to start earlier. So there's a big reason why you do it, just to be ready to act. I also think it is a valuable continual benchmarking exercise that one does to test themselves and make sure that we think we have great managers. Do we? Are they remaining great? It's right. So it's like a healthy benchmarking exercise. So one of the expectations of the senior directors is, you have command of your universe outside the walls of the managers that we work with today. And there's different levels to the level of due diligence we're doing and the stages we're at with different managers. It's pretty rare that a manager that runs money in a mandate that aligns to something we already do, that we won't take an initial call. Might be a short call to start, just to get introduced and meet the manager. Maybe a senior director doesn't get involved at that point in time, and it's just an analyst. But as we start to learn more about the manager, we'll do desk research. We'll start to increase the level of engagement with them, introduce the senior director, and then once they get very far along is when I might get introduced to start thinking about that manager. We try to carefully manage it with the managers, though, because we don't make a lot of changes each year. So if we make 2 or 3 manager changes in a year, that feels pretty busy. So we're not a place where people know that Vanguard's not going to be placing these mandates all of the time. So we try to also manage the expectations and manage a relationship with the managers that, hey, this is a get to know you process. We want to get to know you very well over time. And it may result in something, and it may not. So there's also an element of managing the relationships with the managers so that it's, obviously we get what we need, but we're not doing too much with managers too quickly at times, because, we don't want to be, want to be respectful effectively and open and transparent with managers about the opportunities that we do have. So it's a constant process. We refer to it as an evergreen process. We don't run RFPs. The mandate is be ready to act. So I have this concept of search readiness. And, part of what, we talk about with the senior directors is, where do you rate your search readiness in each of your categories? And sometimes they're not always green, and that's okay. Sometimes they're not quite green, right? More of an amber, and that's okay. And then it's like, all right, well, why is that the case? Some categories are a little tougher than others. Maybe we don't think there's a likelihood that we're going to need to act in the next year or two, so we feel like it's a lower priority, because you can't do all things all the time, so you do have to prioritize your time. And these are ways we try to think through that equation of remaining deep on what we need to remain deep on, but remaining broad and out there in the industry and in the market, so that we know the space, because it's not just the managers we work with today.
Yeah. And I think I hear managers say this themselves about, doing a huge amount of work for very little, in the sense that you're doing all of this work, all of these meetings, all of this deep analysis, and actually the number of changes are, if it's 2 to 3, that's quite a lot. So it's always, it must require quite a patient persona to be prepared to, to grind through all of that work and know that work might not come into play for 3 years or even longer. So it's kind of interesting. Is how do you think about when you're hiring people? How do you think about kind of, I presume, some of them are coming, maybe, if the young people may be coming straight out of uni, I don't know, but are you hiring people from other firms where they've done manager research before, where I would imagine that things are perhaps a bit busier, or not busier, but a bit more active, let's say?
Yeah, so from an analyst level, we hire in a few different ways. We have different development programs for folks that just came out of school, and more investment rotational type. So we'll bring some people in through those rotational programs. We'll hire internally in other ways as well from different groups. And these folks can be a little earlier in their career. We have done some external hiring at the analyst level to bring different perspectives in, but we haven't done a lot of that. Most of the external perspective that we have is at the senior team right now, where they've done work elsewhere. Not always manager research. Like I have somebody that was more in private equity. I have somebody who was actually on the buy side before, just was on the other side of the table, which is an interesting perspective for somebody to bring. So it's a mix of backgrounds. We, I would say we have looked externally a little bit more of late, just to try to get a sense for what other perspectives you can bring, because I do think there's a balance of internal and external. You want to make sure that you're not too insular and you're not too internal. You got to be out there, right? You want some outside views. So I think we're trying to think about that a little bit more to see, is there anything else out there that we maybe haven't leaned into as much as we maybe could on a go forward basis. So something we're thinking a little bit about. And we're trying to be a little bit more external with things like industry events and conferences and things like that too, to bring some other external perspectives. I think there's just a lot of change going on in the industry. A lot of people are moving around. There's a lot of consolidation. Private markets are just introducing something different in this whole ecosystem, if you will, that I think we just really got to be on top of. So I also feel like we're at an interesting point with our industry that might lead you to want to think about other things a little bit differently than we have in the past. And sometimes thinking a little bit more external helps you with that. So that's kind of a little bit of the why we're thinking about that. But what I do find is manager selection for sub-advisory and in the use of like your funds versus fund selection in the context of, say, a wealth manager, they're very similar, but they're also very different, right? And when you're in fund selection, there's oftentimes a much bigger universe of funds that you need to evaluate than there is if you're just looking at managers for use in a sub-advisor. And I think there's just a different way that you approach it based on the use case of your manager research effectively.
Completely, yeah. Funnily enough, our last guest was on the sub-advised side, actually. So that's two sub-advised manager research teams in a row by coincidence. But yeah, I completely agree. That's that classic thing of like similar but different. One thought I had while you were talking about the team. So I was interested, something must have sparked this thought where some of the work that you do is obviously, numeric. Some of the work is, you talked about that kind of quant-qual combination. To what extent, and especially given that you've got the resource, to what extent are you researching into the manager and their kind of personal situation? I have no idea if that's an area that you spend any time on, but it popped into my mind. So I would just be intrigued to know whether that plays a part in your process.
And so when you say personal situation, can you just expand on that?
Yeah, so for example, I've heard examples of managers who things have kind of fallen out of favor because perhaps they're going through they've got personal issues, like maybe divorce. Like I've heard of certainly on the equity side, private investigators being employed. That's on the equity side rather than on the fund side, but being private investigators looking to make sure there's nothing untoward in relation to this, to the C-suite basically. And I just didn't know whether you think about anything in that realm for your managers, because given you said sometimes you want it to be, well, ideally you want it to be decades rather than years. Clearly you kind of need to be fully confident. So yeah, I just didn't know whether that was an area that you spend any time on.
Well, I mean, we do think a lot about the quality of the firm, the culture of the firm, and the people, for sure. Obviously, that's a big part of what we look at. I'm not going to say we dig into folks' personal side of things a whole lot. Okay. Now, there are instances where we have come to learn, about different personal situations that somebody may be going through that could be impacting their behavior, if you will. Like, if you're going through a very stressful period of time in your life, well, there's definitely a risk that could manifest itself in the way in which you run the portfolio. And we have definitely had instances like that before, where we've had that situation happen with managers we've worked with. In some instances, it has resulted in, I think of one instance in particular where it did result in making some changes, right? Wasn't necessarily an ethical thing or anything along those lines, but just something there. We don't do a lot of PI kind of work to kind of get that. We try to, it's part of the reason why we do things over time. It's part of the reason why we try to meet multiple people at different firms.
Yeah. Is
you just try to piece this together. And we'll all talk a lot about culture, right? And culture is critically important. It's also one of the hardest things to really get to know.
Yeah. And
you've got to triangulate a little bit. So yeah, we will do cross references to get a sense for like, what's the reputation of working at the firm? How is so-and-so received at the firm? What's the reputation of leadership? Yeah, we'll do that kind of stuff, but I don't want to overstate anything on the PI side of front.
Yeah, to be fair, I haven't heard of anyone doing that on the fund research side, but I was just for whatever reason it popped into my mind. But no,
Well,
it makes perfect sense.
yeah, and listen, I mean, there are, when we hire somebody or when you invest in a fund, you want to avoid, you don't want to have situations where all of a sudden you're associated with something you don't want to be associated with, right? And in all of anybody who's in this business, I suspect, are very proud of our firms, and protecting the brand is really important of firms that you work for. And I know Vanguard's very big on our brand, so yes, it's definitely something you need to be mindful of. We do enough to try to be comfortable, but it's always going to be a risk. It's always going to be a risk.
For sure. And things change, right? So yeah, completely. Cool. So I would be interested to move into your process, or rather actually philosophy, when it comes to the mandates that you have. Obviously, I'm presuming that there's a decision to create a fund, and then the manager search is kind of related to that. So there are kind of the parameters around that search that you're looking for X or Y. But is there any thread amongst presumably you're involved to some degree with the kind of the product decision making. So, if you were given, you wouldn't, I imagine, be given a mandate for a strategy that you would just say, actually, I can't populate that. So I presume there's sort of interaction prior to that point to make sure that you can do it. Is there a thread between the mandates that Vanguard has sub-advised, that is the kind of the way? I mean, obviously you talked about value and growth, so that's kind of one sort of lens, but are there kind of tenets that you and the team are looking for when you're looking for managers?
It will depend on the mandate and what we're trying to achieve with the product that we're bringing out. So if I go back to say 2016, okay, and I go back to this time very purposefully because this is when we made the decision to launch Active in the UK. And at the time, I was a senior director in the team that I now run, and I worked very closely with the product development team in our UK office. And there, the conversation was, well, what products do we want to bring to the market, right? And that was very much, well, what do we think who are we trying to serve, and how do we want to serve them with what types of exposures? And we ended up bringing a few different products out, like a global equity product, a global emerging markets product. So we have the exposure. And yes, then there's can we fill it? And of course, the answer was yes, we can fill it. And then we've had conversations about, well, what do we want the character of the fund to be? So if I think about, say, like a global equity fund, well, we could have tilts in it. We could have it be a more core exposure. You want it to be all cap, all these different parameters, right, about what we want the fund to be. And I'll just keep with this particular example. It was very much, we want the fund to be a core holding. We want it to have very limited style bets. We want manager diversification within it. But we also didn't want it to be overly diversified, because our view would be advisors who might consider it, or even individual investors who might consider it, they don't want an over diversified active fund. So that led us to, well, let's try to do a fund with 2, maybe 3 managers that are complementary in the way in which they approach investing on a global basis. So then, can we fill that with talent? Yes, we can fill that with talent. So we paired a value-oriented manager and a growth-oriented manager, so that when you put them together at the overall fund level, it's more of a core exposure. So it would look more like the FTSE All World Index from an exposure perspective. You're going to have modest tilts here and there, right? It's just the nature of active. But we tried to make sure that, hey, if growth's leading, we've got a little help from the growth manager. We're probably going to get help from the value manager, and vice versa. Assuming you hired a good manager and their stock selection beyond their style, over time that alpha can become additive, but done so in a lowly correlated way, so that the smoothness of the ride is a little bit more than it otherwise would have been with something a bit more extreme. So we'll go through that process with any new product. We'll also go through that process anytime we are thinking about making a change. So we might identify a manager that we have developed concerns with. We will work with the product team, and we'll say, this is the manager we have a concern with. This is the style they bring into this fund. So if I think about maybe a purely value-oriented fund that we might offer here in the US, there's different flavors of value. If it's a manager who happens to be a deep value-oriented manager, do we want this fund to still have the same character afterwards? If the answer is yes, well, then that means we need to go to our deep value bench. If the answer is no, it's actually too deep value, doesn't have enough quality in it. We might need to start thinking about more of a quality value manager. Now, we're always going to prioritize top talents. We're never going to put a manager in that we don't believe is, a very good manager. But being aware of what we're trying to achieve with the fund and the exposure, we do meld that together, which is why I say every circumstance is different. And it's like in the UK when we launched a range of multi-asset active funds that the team wanted to have a bit more of a sustainable bent to it. All right, what do we want the parameters of that to be? How, what sustainability features do you want in that, and then how do we think through the filling of that order, if you will, for the manager to align with what we're trying to achieve, what we're trying to bring to clients. So hopefully that gives you a sense for how it can work, but we need to be ready to fill the order in any way that might come our way, which goes back to, that's why the team needs to be out there, meeting with managers, doing the desk research, monitoring the universe, so on and so forth.
One of my favorite exercises I remember when I was heading up the team at Saracen was when we populated this kind of spreadsheet of all these rows and columns, and it was basically every sector that we had, and then it was kind of all the different style bents that you could have, and it's like a little menu of selecting this and that. So yeah, it just reminded me of that process, which was so valuable, right, as well, to like map the universe and have that understanding of kind of, okay, yes, that's value, but to your point, like, is it deep value, is it quality value? Like, those two things are so different that sometimes a value manager at one end could actually be closer in style to a growth manager than its kind of deep value version, even though they both sit in the same kind of style box. So yeah, that's definitely makes a lot of sense. What I'd be interested to move on to is you referenced obviously data being a big part of what you do, and you talked a bit about kind of the expectation point, right? About some managers we're invested in them for this thing, and actually if they don't deliver, actually that's kind of, you alluded to the fact that that's the right thing, if that's the expectation. Sometimes it's really difficult, right? In fact, you actually said it earlier, like that's the hardest thing, right? To know whether it's like, is this the time we should take action or not? Can you perhaps talk us through an example of where stocks, if you look at the attribution, you talked about kind of that being part of it, but not like the absolute core of what you do. I'd be really interested to hear of an example where you had a manager and they were underperforming, but actually you sort of weren't sure whether that was because it was expected or whether actually that was an indication of something going a bit more awry. So I just that kind of line that you actually guided us to earlier, can we actually find an example that was sort of on that line, and kind of which way did you go?
Yeah, I mean, I think there's ways we've went stay, and there's ways we went move on. And if I go back to thinking about the ways we've evolved the most, I think this is towards the top of the list. And this gets to the whole idea around being really clear about what a manager's philosophy and process is and what the edge they bring to it, and trying to distinguish between that philosophy and process and some of the inherent tailwinds that can come with it, or headwinds, and anything beyond that. So it is absolutely, it is so key to what we do. We've had, I could think of one I'll go back to deep value since we started talking about deep value. And that's a part of the market. When we look at deep value, I'll start at a higher level. When we look at a deep value approach, actually, generally speaking, if you put a deep value, naively implemented deep value strategy out into most universes, it actually generally won't work, right? It'll generally underperform. And I'm talking like real deep value, not like a lowest half of the universe. I'm talking like lowest decile type of deep value, because there's so many falling knives in there, right? There are so many stocks that are going to, not necessarily zero, but they're going down, and they're going to keep going down. They're probably not going to recover. So when we look at deep value managers, the first thing we know is it's hard. It's hard. And it's like, so what that means is the starting point is a headwind. So it's all the more reason why when we evaluate a deep value manager, we have to be that much more confident in the quality of the research, the unique insights, the ability of the managers to overcome that, what I would call a headwind. So when we rate managers, generally speaking, a deep value approach is from like an efficacy perspective, gets a lower rating for us. The opportunity for payoff, the opportunity for skill is greater in deep value than it is quality value. So when we look at these managers, in the case of deep value, the manager I'm thinking about, wow, you have to, this is a particularly a concentrated deep value manager I'm thinking about, you have to be confident that they are going to be able to identify, honestly, only 2 or 3 big winners, and it's going to work, right? So for this particular manager, they've had a very volatile series of performance for us, but that's okay. We've sized them appropriately in a fund. There's been periods where when we look at that, there have been misses on the big positions, and those are the years we had the big drawdowns. But as we stitch that together over the many years, and we look at things like the batting average or slugging percentage, I'm not sure if these are terms you would.
Batting average, yeah.
You're like, how many stocks do you get right? And then when you get them right or you get them wrong, how well did it go? How poorly did it go? And there's different managers when we look at that, and we call this skill-based attribution. We actually expect a sub 50% batting average, but we expect a very high slugging percentage. And so we're starting to piece together a little bit around, in this case, we saw a lot of high slugging percentage situations, but we also saw some periods where that went the other way. But as we strung that together over the years, we said, we got to be able to live with this, and we can live with this. And when we do the qualitative work with the manager and you sit down and you go, why do you own this stock? Like this stock, nobody's going to touch this stock right now, right? And, we prepare for these meetings. So like one of the things we do when we go we're going to go talk stocks with managers. We don't just show up and say, hey, talk to me about the stock. We do work on the company. We get a sense for like, what's the market already kind of saying out there? And then that helps you get to sense, okay, well, what's different? What's your differentiated view? And that's part of the qualitative insights we try to bring on the quality of an analyst. We say, they're bringing something, they have a unique perspective. Now, it might be wrong, but at least it's different, right? And there's awareness about what's in the market, what's already priced in. And you get that qualitative insight based on the companies that they own. You look at some of that quantitative data I've read, and you say, no people changes, no process changes, just something we're going to have to live with, and we're going to stick through it. And I will say in this particular manager's case, some of those periods have been pretty rough, and we have gotten challenges from our committee, right? And with our committee, it's like, no, we got to stay through this, right? So that's like an example of how we would have worked through one where it's kind of worked on the good side of things. There's been others where it's went the other way, but that's something else you have to be comfortable with as a manager researcher, is you're going to get some wrong. Like none of us bat even close to 100% in this business, right? Not even close. I mean, if you're right 60 to 70% of the time in this business, you're actually really, really good.
Yeah, completely.
And that way.
Yeah, no, I quote that all the time. It's really key. One thing that struck me there was when you're in your team and you've obviously got seniors, you've got analysts, you've got yourself, you've got a couple of other people on the team. How do you, and this is my kind of last question before we dive into the usual podcast kind of concluding questions, how do you encourage a team? You talked a lot about culture, right, in the funds that you're selecting, the firms that you're looking at. How do you encourage that like pure and true kind of what the Bridgewater guy, who I've temporarily forgotten his name, with the book Principles, Dalio, like that kind of radical truth. It doesn't matter what level you are, you can kind of say anything. Just interested in because that point you just made about that being actually really hard to change your mind, and obviously your seniors are the ones that have, at least for the most part, been more involved, probably more, of course they're more experienced, but I was just interested in how you encourage that like really pure pure kind of devil's advocate, because it's so hard to do that. You have to have such a level of trust. So yeah, we'd just like to kind of finish up with my questions on this section with how you do that in your team at Vanguard.
Yeah, I think there's a few things that are important on that. One is the relationships within the team are critical. And I'm a big believer in personal relationships as part of your work relationships. I'm not saying everybody has to be a best friend and hang out with each other outside of work, but it helps to build the trust. So you've got to have that within the team. So you do have to invest time in personal relationships within the team to create an environment of trust, because that really helps people understand when somebody does come at you or challenge you, it just gives you you understand the intentions a little bit better, and you understand they're in the kind of in the spirit of a better answer, right? So it's like this whole concept of like, you challenge the idea, you don't challenge the person, which we really try to make sure that's understood. And we try to build that with a foundation of relationships within the team. As a leader of the team, I try to reward it. And what I mean by reward it is when I see it and when I hear it, great point. Really like that challenge that Alex just brought, right? Like you got to sprinkle like small things in to make sure people know it's okay. You really do. You have to make sure people know it's okay to challenge you, even as the most senior person in the room. So I'm very thankful to have a team that has no problem challenging me. And that's good. That's a really good thing. And I've got to receive that challenge, in a way. If I don't receive the challenge in a way that shows the team I was okay with being challenged, you're going to shut that down in a second. So there's like general leadership stuff that I think is important in this. Within the process, we have a dashboard. Most of us probably have some sort of rating system that we use. We have a high level drivers, we have some sub drivers within it. There's a range of ratings. Use the range of ratings. Use the range of ratings. It sounds so easy, but it's not. Right? If you think something's a little more average about this component of their process, I don't think that means you're saying fire them. I think it just means I don't think this part of their process is as strong as this part of their process. Use the ratings, because then it gives you a sense for really where's our conviction highest? Where is it deteriorating? Where is it the lowest? Differentiation amongst your managers, differentiation amongst components within the way different managers think about similar topics. This is good. And you got to make sure people are comfortable raising, it's like in a RAG rating system, sometimes you got to use red. You don't ever use red, you don't have a RAG rating system serving its purpose. So there's like some things within the process we try to think about too. But I think that's more leadership and culture than anything else.
Yeah, I agree. The dashboard and the ratings and all that. There's a lot that if we had longer, I would love to dig into, because I think, number one, a thought I had earlier that I didn't ask was around consistency. Consistency across a big team. How do you make sure? And it sounds like this is a big part of that. And then also, to your point, sometimes things are certain bits of certain forms, or however you call your kind of your rating system, will be more important for certain funds than others, right? So an amber on one manager in that section might be like, oh gosh, this is like this, we really need to deal with this, whereas an amber for another manager on that same section may not be as pressing to the kind of the decision. So it's such a nuanced thing, isn't it? But it's sounds like that's a whole topic we could have dived into for another podcast. But thank you, Matt. That was really, really interesting, and I think it's certainly, I think, a testament to Vanguard to have invested in such a clear way in an area that as you say they've believed in for so many decades, much to the kind of the opposite of what some in the market would say. So I think it's been a really good kind of drop into some of the bits that you are focused on. So thank you for sharing so openly and helpfully to the audience. As I think we finish up with a few questions. So the first question for you is, what book, it doesn't always have to be a book, but generally a book, that's had the biggest impact on you in your career or life so far?
Yeah, so I'll share a book that definitely relates to what we do as manager researchers, because if you think about what we're doing is we're hiring people to predict the future. future of stocks, the future of markets, so on and so forth. So what are we doing? We're hiring forecasters, right? So I'm sure many will be out there is the book Super Forecasting.
It's a corker.
Right. And it's just, I think if you go through that book and you just think about some of the lessons that the authors share based on the studies they did of those that proved to be super forecasters, to use their term, things like how one adjusts to new information, right? Really important in investing. Portfolio managers get new information all the time. How do they adjust it? Do they demonstrate the ability to adjust it? Getting internal views, external views. How do they bring that in? How do they think about, point and counterpoint kind of conversation so they understand all angles? It's like a classic, if there's a bull case for a stock, but what's the bear case for the stock? If you can't tell me the bear case for a stock, I'm not sure how fully you've thought through the stock, right? So I think there's a lot of things within that super forecasting book that applies directly to manager research, given, as I say, that's kind of what we're trying to do. We're trying to pick people who can forecast the future, and that's hard.
I absolutely love that book so much, and just by complete coincidence, on the weekend, I was actually telling my kids. My kids are only 7 and 5, and I was actually telling them, not obviously telling them about the book, but I was telling them about that concept, the really simple concept that, when somebody says, do I think this is the case? It's like somebody might be saying like, yes, I believe 80%, but somebody might only be like 51%, and just trying to like help them realize that. I can't remember even the context of why I was telling them about it, but yeah, so it's coincidental that you've mentioned that book. It's as you say, there's just so many lessons in there that are so applicable, both for, as you say, when you are interviewing managers to see how much they adhere to some of those lessons, but also obviously you as a researcher for yourself to do that as well. So it's a multi-layered thing. So yeah, great choice. Cool. So second question for you is one that was asked by the previous guest. So I mentioned the previous guest was also a kind of sub-advised approach with manager research. So Hannah Evans from Omnis Investments. So she asked what your biggest bugbear is in manager research.
So there's a couple of things here. One of which I think she touched on in her conversation with you, which is just telling the truth. I forget exactly how she phrased it. But that is actually something that can bother me. I don't want things to be sugarcoated. Just tell us how it is. So that does bother me. But she already talked about that last, so I'll avoid that. even though I did just say it. I increasingly get not necessarily frustrated, but I increasingly expect fund managers to do more of the work that we do themselves. And what I mean by that is they know how we're going to analyze the portfolio. They know that the markets have changed. They know there's different ways that we can dissect their performance. Think about smart beta ETFs and index products. Well, there's another lens that people use to assess your value approach. And I think fund managers need to make sure they're doing a lot of work to keep up with the work that manager researchers to do to really dissect their performance. The game has changed. The tools we have evolved to dissect skill versus luck. I just think it's not a red flag necessarily that they don't, but I just think they need to be thinking about this. Go back to super forecasting a little bit in that. How are they adjusting to new info? How are they learning? And if I don't get a good sense that managers are doing something that demonstrates awareness of how this is all evolved, I don't love that.
Yeah, it's a really good kind of point to end on, because it's so true that things have evolved enormously. I mean, my kind of looking back to how things were, is things have just evolved massively, not just tools, but also kind of approaches. And I think it's you're right, the asset management is a tough market at the moment, and there has to be recognition of what the kind of the things are that you need to do. And it's not, as I think Hannah actually said in her episode, it's not about saying change. It's actually about doing exactly what you do, but just understanding it completely and having the context. So yeah, that makes a lot of sense. So there we go. There's a bugbear for sales and fund managers to pay attention to for the future. So the last job for you is to ask a question for our next guest, who you don't know who it is yet, but what question would you like to pose to them for the next episode?
So I would, obviously, I would not expect them to disclose the exact situation, but I would love to hear about a manager research mistake they made and how they came to determine it was a mistake and how they just kind of worked through it.
Nice. Okay, that's that's going to be a good one. I'm sure we'll get a lot out of that. Fantastic, Matt. Thank you for being a great guest. Thank you for joining us on the Fund Selectors podcast. It's been a pleasure.
Thanks for having me, Lucy. I enjoyed it.
Thanks, Matt.